All right, we will get started here. Thank you so much for joining me this morning for our quarterly plan sponsor fiduciary training. My name is Jenna Witherby, and I'm one of the advisors on the team at 401k Plan Professionals. On behalf of all of us, again, thank you so much for joining. This is something that can be watched and even rewatched. This can be shared. Perhaps you are on a committee that we currently work with. Maybe you're new. I think this is a great way to learn more about our process, the way that we run our meetings. And even if you're not new, I think it's a great way to kind of refresh on this information, and feel free to pass it along to a colleague or anybody that you think would find value in it. So this is a part of our quarterly fiduciary training series. So about every few months, we host one of these trainings, and it may not take the full 30 minutes, but we'll get through the content, and at the end, if there's questions, we can do a Q&A. And even throughout, as I'm speaking, feel free to use the chat box if you have questions that come up, and we can take conversations offline as well if it's questions that are more specific to you and your plan and your committee. The next fiduciary training will actually be on May 5th. And a link to this recording will be distributed afterwards, and they will also live online. It's something that I'm more than happy to send you in the future too. So if you lose track of it, I can always get that to you. So we're going to cover quite a bit today. First, talk about what is a fiduciary, then the basic roles and responsibilities that you have as a fiduciary, our team's role as an investment fiduciary. Then I'll walk you through a sample agenda and a committee meeting, go through some screenshots of what the documentation looks like and kind of the reasoning behind why we do what we do, our analytics, our methodology. And then at the end, I'll briefly explain an optional training and credential that you can go through. We foot the bill for it. So I'll give you the link and the code to sign up for free. And this is just something above and beyond this particular training if you wanted to do a deeper dive. All right, so first I'm going to launch a poll. If you could please quickly rate your confidence when discussing who is a fiduciary and your own role and responsibilities. So I'll give you just a few seconds here. It's either I do not feel confident, somewhat confident, or very confident. And this is helpful for us as we are, putting together these trainings and working with our committee members. So it looks like kind of a third, all across the board there. Okay. So ultimately, we want you to feel very confident with your roles as a fiduciary. So going into what it actually is. So there is a straight definition of it. It comes down to it's a person who owes a duty of care and trust to another. And here's the key: it must act primarily for the benefit of the other in a particular activity. And a great example is, you might be serving on an investment committee for a 401k plan or a 403b, and you might also be a participant in the plan itself. So you really, when you're acting as a fiduciary on a committee, you really need to remove yourself from a participant view, and really you're acting on behalf of all of the other participants in the plan. So fiduciary status is really based on the functions you perform and not a title. That's key as well. Fiduciary duties come into existence when a person or entity is entrusted with the property or power on someone else's behalf. So in our case here, a company, an organization may offer a retirement plan as a great benefit. As a fiduciary, you're taking control of the participants, or in other words, the employees' investments. And that's why that duty arises, to make sure that you're ending up benefiting those employees, not just the top paid, not just the C-suite, not the company itself, but the employees that are a part of this 401k plan, and past employees as well, anybody that leaves a balance in one of these plans. So there's two types of fiduciaries. There's named fiduciaries, which would be specifically identified in a plan document. So this could be in your legal adoption agreement, summary plan description, just some legal document that says your name. A named fiduciary could be an employer, a company officer, could be a third party. And on the other hand, there's unnamed fiduciaries. So these individuals have a fiduciary duty as a result of the role that they play in managing the 401k. If they make decisions about the plan assets, for example, they're a fiduciary whether they're named or not. And I think a really great example here is somebody that perhaps works in your payroll department. That particular individual might not be named on any of your documents, but if they're the ones that are every payroll, they're submitting the contributions to your 401k provider, they in essence are a fiduciary. So ERISA, Employee Retirement Income Security Act of 1974, and its regulations provide that the following are plan fiduciaries: anyone who makes a plan related decision or has the ability to do so. And then here's where our team comes into play: anyone who provides investment advice to a plan and its participants and receives compensation for doing so. So ERISA has kind of bucketed fiduciaries into those two different camps. And here's an important distinction, is that there are straight business decisions and also fiduciary decisions. And so we're able to make that distinction between the two. I know the courts do this as well in lawsuits that come up. So for instance, just the straight decision to have a plan, design it a certain way with match, profit sharing, different eligibility requirements, different distribution requirements, the decision to change the plan design or perhaps terminate a plan, those are straight business decisions. However, when you take steps to implement those, or say you're hiring a firm to help you implement those, then you are acting as a plan fiduciary. And this is kind of a wordy slide, but this is really what it comes down to as far as your basic roles and responsibilities as a fiduciary. So Congress imposed strict standards of conduct, responsibility, and obligations. And it's basically these 5 bullet points here. So basic fiduciary duties include managing the plan with only the interests of the participants and the beneficiaries in mind. So I already kind of touched on that. So really acting prudently for those individuals, keeping plan expenses to a reasonable level. This is very key, continues to become more and more key. Following the terms of the plan's governing documents. So in other words, you've got your legal adoption agreement, your summary plan description, making sure that you're actually doing what this document says that you're doing. So following those terms, ensuring the plan's investments are diversified, covering many different asset classes, and doing all of this with care, skill, prudence, and diligence. And then also, as a side note here, ERISA also specifies, of course, that fiduciaries need to avoid engaging in any sort of prohibited transactions, and some of those are listed there. Another thing to note is something we're finding with larger organizations, perhaps larger plans, just even in terms of their assets. Sometimes they prefer a committee charter. So their board of directors may prefer that they have a signed like legal committee charter on file as well, kind of indicating the individuals and what they're able to do and what types of decisions that they're making. We just have a handful of clients that either have a committee charter or have thought about it, but that's something that we may see kind of grow in interest. But yeah, this is basically what it comes down to. If you wanted to take a screenshot of this slide, this is the main roles and responsibilities that you would have as a fiduciary. And like I had mentioned, the fees is that's just in and of itself becoming more of a hot topic in our industry. There have been many lawsuits filed against plan sponsors and committees for various reasons, but a lot of them have to do with plan fees. And this is just one particular example that was published in January. And actually, as my team read through this and looked over it, we even thought to ourselves, and we talked amongst us, like, good, everything we do and our process that we have in place protects us and committees against these types of allegations. And I'll go into in a moment more of what we do. But this Hughes versus Northwestern University lawsuit was brought by a few university employees who were claiming that their 403B plan fiduciaries violated their duty of prudence by doing a few things: failing to monitor and control the record keeping fees, offering mutual funds and annuities in the form of retail share classes. So instead of having institutional share class, lower cost type investments, they had more expensive type investments to choose from, and then offering complex investment options. Also in there too is just having too many, that it was confusing people. And ultimately the Supreme Court did rule in favor of these university employees. So despite the plan sponsors saying, well, yes, we have some more expensive investments, but we also offer some less expensive investments. We also have index funds in our lineup. And so we have a variety. They don't have to choose the more expensive ones. But this case was a great example and a great reminder of why every investment in the plan needs to be monitored for not only the performance, but also the expenses. So best course of action here, conducting, and again, we do all of this. I'll go into this in a moment, but fiduciary prudent practices, making sure you have periodic committee meetings and documenting those really well, and then limit, monitor, and curate the plan's menu of investment options. And if the committee themselves, those fiduciaries don't feel apt to do that on their own, hiring experts to do that, to benchmark the plan fees and to document the process that they have in place. And really, again, that's where our team comes into play. So what our role is we act as either a 321 or a 338 fiduciary. I'll go through the few different types of fiduciaries here and kind of tie that into our kind of day-to-day. But ultimately, a named fiduciary may designate other fiduciaries to oversee various plan functions. So that would be the committee members. So that might even be you, and you are saying, okay, we need to hire an investment advisor or a team of investment advisors to help us reduce and mitigate our fiduciary liability. And there's 3 different types of fiduciaries that are established by ERISA. 316 is a fiduciary more on the admin side of things. So that's making sure that the plan is in compliance with the plan documents, handling the reporting, disclosure requirements. So things like making sure you send out the annual fee disclosure or the annual safe harbor notice or the annual QDIA, the qualified default investment alternative notice, making sure new employees get the summary plan description. So things like that. And then the 2 that are in the box, that's what our team essentially does. We're either hired as a 321 investment advisor or consultant or a 338 investment manager. I'll tell you, our activities are essentially the same. The difference is who makes the final decision. If it comes down to an investment being removed and replaced with another investment, or we're adding some investments, or we're changing providers and we're picking a new menu of investments. Ultimately, if we're a 321 advisor, we give you the information, the analysis, and we'd give you our recommendation, but the committee ultimately gets the final decision. Whereas in a 338 environment, again, we do all of the same things, but essentially the decision would lie with our team. we would tell you, here's our recommendation and here's what we're just going to do. And so some committees have decided, we want to offshore some of the investment type fiduciary responsibility, hire you as a 338, so you get the final kind of call. And that never, this bottom point, it doesn't let plan sponsors totally get rid of any fiduciary responsibility. You can't step down from your role because you're still choosing our team as advisors, and you're still choosing your provider, and you're still having to submit contributions on time. So there's many other facets to it, but when it comes down to the investment fiduciary liability, that piece of it we can kind of take over. So I hope that makes sense. And some teams will charge more money if they're acting in a 338 capacity. We typically don't, because our viewpoint is we're literally doing the same amount of work. We're doing everything the same. It's just at the end of the day, we're documenting that we made the decision instead of it being a committee in agreement type of a decision. Okay, now walking through an actual committee meeting, and if you've been a part of a committee and worked with us for a while, this might be, kind of repeat information, all of this, but I think this is helpful for especially new people and can even kind of give you more of a glimpse into why we do what we do. So we have an agenda for each committee meeting. We'll send it out typically in advance and or bring it with us to that particular meeting. It's a nice guide too, just as we're going through our conversation and making sure we hit all of our points. Minutes. So we take the minutes of all of our committee meetings and we house them. We also send them to you in advance of each meeting. We may send them out after the meeting as well. Some committees like to actually sign off on their minutes and approve them right after the meeting occurs. If your committee didn't already approve the minutes prior to coming into another meeting, that would be one of the first things that we do. So on this agenda, you can see that the minutes is kind of that first listed item. We'll review the minutes from the previous meeting, approve them if they haven't already been. We might kind of give a brief summary of what had occurred at the last meeting and if anything had happened in between the two meetings. And frequency of the meeting, by the way, some committees have kind of fallen on, they like semi-annual meetings. Some are annual. I would say most have gotten away from meeting quarterly in this kind of a setting. We do send quarterly due diligence electronically. So we still are doing that process quarterly. It's just maybe we're not meeting. And if something needed to be addressed, by the way, we would just call an extra special meeting in between. So agenda, minutes, and then plan review. This just kind of indicates the provider themselves. They typically have some sort of a maybe annual or quarterly review or executive summary, kind of going through plan metrics, cash flow, participation, kind of those data points behind the scenes. And perhaps we may have a representative from a provider attend the meeting as well, or every other. Just depends on what the committee prefers there. And I'll go into some of these other reports. So I would say a bulk of the investment discussion, it falls on these couple of summary pages. We also give you supplemental information, a lot of data and pages from Morningstar, and we use LPL's firm analytics as well. It's a qualitative and quantitative scoring system. Anyway, in these couple of main pages, we take the most pertinent data points and we summarize them on these pages. So they're easy to look at. If you've been in meetings with us, you know these reports, but one of them is the past performance across different time frames, manager tenure, expense, percent technology, turnover ratio, comparing your funds to indices or benchmarks. And then the red and the green sheet, that is our scorecard. And that one is really nice on the eyes. It's a great way to see if there's any trends, any issues that might need to be addressed, anything that flags and shows us this may be cause for concern. So on the scorecard, we're comparing each fund to funds just in its peer group. So we're comparing your mid-cap growth fund to just other mid-cap growth funds in the mutual fund universe. If you have a large value, it's just being compared to other large value funds. And on this one, actually, the lower the number, the better. If it is shaded green for that particular time frame, it ranked in the top quartile of its peer group. If it's white, it's in the middle 2 quartiles, so kind of average in the middle. And then if it's red, it's in the bottom quartile. And on this sheet, of course, we still show you the shorter time frames, 3 months, could be year to date, 12 months. But really, I'd say a bulk of our decisions are formulated on more of the longer term performance that average over the last 3, 5, and 10 years. But it is still a great way to see trends and perhaps changes. We also put the manager tenure on this sheet. If it's flagged red, it means it's a manager tenure of less than 3 years. In other words, that particular investment portfolio had a recent change. That doesn't mean we remove the fund right away, but we might be watching it a little bit closer. And then kind of on the right-hand side of the scorecard, we pull more data points about your particular plan. So how many people are in each fund? How much in your plan assets is held in each fund? What percentage of your plan assets is that? And gives your total plan assets there, bottom right. We also keep track of your internal watch list. So we might come into a committee meeting like this one with 3 funds on our watch list. That may mean a deeper dive, a further conversation. We like to be proactive of conversations. We maybe had brought several alternatives that we had already screened, so we can have educated conversations and possibly make a decision about a change during that committee meeting and not waste any time going back and forth. So that's what that watch list column is. And all of our discussions and our points that we make and the watch list on and off, that's all documented back in the minutes. So the minutes are really that summary of those conversations. I had mentioned something called the LPL firm report, qualitative and quantitative scoring system. So this is an additional kind of supplemental report we may flip to. Here's in the upper left, it shows the different criteria that the funds are scored against. You see not only their past quarter score, but this is nice because you can look back at the last 6 quarters and see, again, any trends, things that need to be addressed. And that's just a brief summary. There's a lot of underlying data, and if we need to do a deeper dive on anything, we certainly do. And here's an investment policy statement, just a couple pages of this about 10-page document. This is a guiding document that we have on file. We don't have you re-sign it every year necessarily, but this is something that we want every committee to have on file. We have it on file, you have it on file, and it's basically outlining our process in words. So things like what may cause removal of a fund, which something that may cause concern, what are the different categories that we have in our plan, looking at performance, fees, looking at your funds compared to their appropriate benchmarks. I'm really just documenting our process in place. And it's better to have an IPS that is loose enough, generic enough, that it's easy to follow versus have one that's too strict and you end up not being able to follow it. And we work with some ERISA attorneys to make sure that our IPS language is appropriate. So we do revamp it a little bit from time to time. And if you have a new committee member, it may be a good idea to, let's review again and we can all sign a fresh investment policy statement. So in addition to knowing what your plan fees are, you also need to benchmark those fees and make sure that they're appropriate. And one of the ways that we do that is we subscribe to this fiduciary benchmark, basically a database of plan fees. And we make sure for your particular plan size that your fees are reasonable. So this database has a lot of different plan fees, and they'll tell us for your size group where the middle 50% of total plan fees fall. In this case, it's 1.02% to 1.43%. Let's say your plan is at 0.85. You can say, okay, our fees are definitely reasonable for the services and what we're receiving. This is just one way that we do it. We also can go out to other providers and get quotes. So we do that periodically as well. Okay, another quick poll. I will pull this up. Okay, so this is helpful for us for further education and webinars. What other topics do you want to learn more about? So if there's anything here that you'd like to see, or drop it in the chat, or you can send us a message if there's ever anything in particular that you want to learn more about. Okay, so couple say investment fees, one for audit preparedness. All right, I'm going to share these results with you so you can see. Okay, so definitely more on the investment fees. And we're hearing that too from our entire industry, I think, is kind of laser focused on investment fees, not only knowing what they are, but again, making sure that you have yourselves covered and making sure that you have, in that example of the lawsuit, institutional share classes, documenting in the minutes of decisions and negotiations that you might have with the provider. Yep. Great. All right, so just a minute here to briefly explain this additional credential you could get. So it's called Fiduciary Essentials for Defined Contribution Plans. And it's just a deeper dive, basically, of what we talked about today. The program identifies the functions and the importance of managing your fiduciary responsibility. They'll illustrate 7 main fiduciary guiding rules and the obligations that you have and how to apply those rules to the decision-making process. So it's a series of sessions, a few quizzes, and then at the end, there's an overall course assessment. Again, we pay for it, so don't got to worry about that. I think this is something that's great for every plan sponsor, fiduciary committee member to go through once and have it on file that you did this kind of deeper dive, continuing education kind of a thing. All right, if there's any questions, feel free to drop in the chat. Otherwise, again, we can talk offline, set up a meeting. If you are interested in doing the deeper dive, you can let us know. I think after we drop off this webinar, there should be a very short survey that pops up, and you can put your email in there if you're interested in the credential. This recording will also go out on our website and our YouTube channel. Otherwise, feel free to reach out to myself or any of my team members if you lost track of it and need it down the road. Our next quarterly fiduciary training will actually be May 5th. So thank you again for hopping on and joining and listening to me explain more about being a fiduciary. Hope you found value in it, and we'll be in touch.